Well, hello everybody. My name's Kent Moore. I'm an attorney here in Cookeville, Tennessee, and I'm going to be talking to you briefly about entity selection basics today. Before we get started, though, I'd like to thank the Business Resource Collective here in Cookeville for asking me to do this. If you want, you can attend any number of these events that the Biz Foundry puts on. I speak, Kevin Christopher speaks, a number of local professionals speak on various topics. Obviously, my topic today will be on business entity selections. And I'll just get started here. Generally, there's 4 or 5 different types of business entities that an entrepreneur may want to select from when deciding which business type they want to use. There's a sole proprietorship. That's the simplest form. We have one owner. There's a partnership. That's a very flexible type of entity, but you have multiple owners in a partnership. There is what's called a limited liability company, where you have a combination of the tax treatment, favorable tax treatment of a partnership, and the limited liability features of a corporation. We have an S corporation, which is that's a little bit more restrictive entity, but you get some favorable tax treatment on that. In particular, you get to reduce your self-employment tax. And then finally, we have a C corporation. That's really if you're going to go public at some point. It's very easy to attract investors. There's an unlimited number of shareholders. We'll dive into a little bit more of these in these successive slides here. Okay. Starting with the sole proprietorship, some of the advantages are this thing is very easy to form. Basically, what you need to do is pick a name and fill out what's called a DBA application in most jurisdictions. Cities and counties will have the forms, if you're even required to use them, just to tell the city and county, it's me, this is the business name I'm going to be operating under. And those forms should be available at most county clerk offices, if not the city government offices. Some of the other advantages, you only get one layer of tax in a sole proprietorship. Okay, and basically what that means is you're going to fill out your 1040 and pay your tax on there. Unlike a lot of other corporate type entities, you can deduct your losses directly on your 1040. So if the business has a $10,000 loss, that's directly deductible to you personally as the owner. Some of the disadvantages are obviously you're the owner. You are personally responsible for all the debts and obligations of your sole proprietorship. That means your house, cars, vehicles, everything could be at risk. You have one owner, it's just you. So it's very difficult to attract investors, indeed almost impossible to attract investors. You'll have to pay a self-employment tax, 15.3% is where it stands right now. And the entity has a very limited life. When you pass away or when you decide to close up shop, that's it. There's no continuity of life for a sole proprietorship. Moving on to partnerships. Those are relatively easy to form. There's no mandatory state filing that's required. As always, with any entity where you and other people are going to go into a venture together, it's universally recommended that you get some agreement between you and your partners, you and your other shareholders, you and your other LLC members, whatever entity it might be. Get those partnership documents ahead of time. As a partnership, again, the owners or the partners, as we call them in a partnership, can deduct the losses of the business on their own personal tax return. So the partnership itself will create a tax return. And let's just say if there are 2 partners and there's losses of $50,000, the partners are equal. Well, each of them will take a $25,000 loss, and they can report that on their own individual tax returns as a loss. Like a sole proprietorship, there's only one layer of tax, so we don't have this double taxation problem like some corporations have. In a partnership, though, one of the nice features of it is, if you have a particular imbalance in resource allocation among partners, what I mean by that is, let's just say one partner brings money to the table, another partner brings expertise. You may want to make special allocations in your partnership agreement of who gets to take what profits or who gets to take what depreciation. You can balance things out in your partnership agreement by making those special allocations, even regardless of what your initial contributions might have been to the actual partnership. You can't make special allocations with a corporation. In a partnership, any entity or individual can be a partner. So you can actually have a LLC as a partner. You can have a corporation as a partner. You can have obviously an individual as a partner. There's no restriction on the number of partners you can have. One of the nice tax features here in Tennessee about partnerships is there's no franchise and excise tax charged to partnerships. We'll see that start to occur in some LLCs and corporations. And again, like a sole proprietorship, a partnership and its partners have unlimited liability for the debts and obligations of the partnership. Now, there is an exception to that. If a partner is actually a limited liability itself, then obviously that partner will have some limited liability protection. But in general, the partners themselves have an obligation to pay for all the debts and obligations of the partnership. Typically, it's usually difficult to add other partners. You're going to generally want unanimous consent from all the other partners in order to add more partners. You're also going to pay self-employment tax with a partnership. An S corporation, okay. In an S corporation, the shareholders actually can deduct losses. What an S corporation is actually a C corporation, which we'll look at briefly next. But you file what's called an S election with the IRS. And in order to do that, you have to have, let's skip over to this next, the disadvantages. You have to have fewer than 100 shareholders. And all the shareholders have to be U.S. residents. We can't have other C corporations, partnerships, or non-resident aliens as shareholders. It must be a domestic corporation. And you can only have one class of stock, meaning that all of the stock has to be treated the same. In some corporations, we have some stock that will spit out more dividends, some stock that has certain rights if they go public, that sort of thing. You can't do that. All shares of stock have to be the same. Going back to one slide here, some of the advantages of a S Corp are, again, we have one layer of tax. An S corporation, just like a partnership, all the losses and the profits flow through to the individual owners. In this case, we call them shareholders. An advantage in an S Corp and a C Corp is that there is limited legal liability. We'll talk a little bit more about exactly what that means. It's not total, you're not free from liability. There's limited legal liability. It can have an unlimited life. Remember back in the sole proprietorship discussion, we talked about how if the owner retired or passed away, that was it. In a S corporation and other entities where we have multiple owners, you can have more continuity of life. A neat tax feature about S corporations is that you have an opportunity to reduce your self-employment tax. Let's just say a company, an S corporation, makes $100,000 a year. Well, any corporation has to pay a reasonable salary to the folks that work there. So let's just say $60,000 gets paid in salary to you. And of course, you're going to pay income tax and self-employment tax on that 60 grand. The other 40, though, you can just make a distribution to yourself and not have to pay that self-employment tax. You still have to pay income tax on that, But self-employment tax being 15.3%, 7.65 to the company, 7.65 to you, that can save a significant amount of money if you structure your operations correctly. Of course, you got to make sure you take that reasonable salary in order to get the benefit of the self-employment tax reduction on the remaining distribution. Okay, so for C corporations, this is what we would initially set up at the state level before we file the S election at the IRS. With a C corporation and with an S corporation, there are mandatory state filings. You have to file the charters with the Secretary of State before that entity comes into existence. Again, with a C corporation, we have limited legal liability. We've got a lot more flexibility, though, with shareholders. Any person, any entity can be a shareholder, and you can have as many as you want. We have unlimited life with C corporations. In a C corporation, though, we have our losses are only deductible at the corporate level. They're not passed on to the shareholders. We do have this double tax issue. Corporations don't have a double tax problem, but there's a double tax issue there. Let's just say a corporation makes $100,000 in profit. It will have to pay tax on that money, deduct that tax from its profit, and then it will have the remainder to distribute as dividends to its shareholders. Well, when the shareholders receive that dividend, it also is taxable. So we have a double taxation problem with a corporation. Currently, corporations are taxed at 21%, I believe, on their income. And that is slated to go up drastically, if I understand correctly. Corporations, C corporations, will pay franchise and excise tax. Just to part briefly on what franchise and excise tax is, a franchise tax is a state tax, a state of Tennessee tax, based on what you own as a corporation, based on what the corporation owns, I guess would be the proper way to say that. And there's a form, a tax form, of how to fill that out. Not everything counts 100%. Leases will count as a portion and things like that. So there'll be a tax on what you own. And then the excise tax portion will be a tax on what you earn, basically your profits. And then our final limited liability entity is going to be a limited liability company. It is a combination of partnership taxation. So your LLC members is what they're called, not a partner as in a partnership or a shareholder as in a corporation. They're called members. Your members will be able to take the profits or losses on their own. The losses are fully deductible to the individual owners. The LLC also is treated as a limited liability entity. So the owners have this concept of limited legal liability. LLCs, with one exception, will file a franchise and excise tax return and pay franchise and excise tax. If, in fact, the LLC members elect to become what's called obligated members, it means the members themselves of an LLC are obligated for all the debts of the LLC, that will then take them out of the franchise and excise tax requirement. Why you would form a limited liability entity and then seek to impose full liability on yourselves, I'm not exactly clear on that, but it's been done before. Some basics for any of these entities, partnerships, corporations, LLCs, not sole proprietorships. It's just you, so you don't need an agreement in writing with yourself. But for any partnership, any corporation, any LLC, you will need to get your agreements in writing ahead of time. It's very important. What do these agreements cover? Well, typically we're going to cover when we meet, what sort of decision-making process we're going to engage in, and what the vote percentage requirements are for moving ahead with a decision. You know, do we want a bare 51% majority? Do we want a supermajority, be that, you know, over 2/3, over 75%? These are decisions that you're just going to have to make by yourself in consultation with your other partners. Typically, you're going to see a higher vote requirement for something that is a little bit more of a drastic or impactful decision, taking out a big loan, selling a big chunk of the business, that sort of thing. Your partnership agreements or your bylaws, whatever you want to call them, will govern how a person becomes a partner or a shareholder in that venture, who controls the day-to-day operations. And, you know, it's easy to get in business. It's not so easy to get out unless your documents have kind of provided or facilitated a pathway for that departure of a partner. Let's just say you want to buy out a partner. A partner passes away, a partner files bankruptcy, does something where there's a need to get that person out of the business and pay them for their fair share of their business percentage. And how you value that and how you do that is usually a very critical part of your operating agreements, your partnership agreements, or your bylaws. Some of these partnership agreements have what I call vote off the island provisions, where some partner does something that's really bad and you can't keep them around. You've got to get them out of the business. And there's typically vote procedures and mechanisms for paying them in exchange for their interest to get them off the island. And then if you want to terminate the company, how are we going to go about doing that? How are we going to pay off all of our debts? How are we going to distribute the remaining proceeds after we've paid off our debts and liquidated all of our assets? So just kind of a more fundamental question, what is an entity? Well, anything except a sole proprietorship, an entity is a separate taxpayer than you. It's totally separate, and it needs to be treated that way. It needs to have its own bank account. It needs to have its own records. You ought not to commingle funds. That means you can't dip into company funds whenever you want to for personal reasons. You can't use company assets, the condo, the whatever it might be, for your own reasons. You can't buy your family iPads for Christmas. That sort of thing. Don't treat company property like it's yours. And then coming towards the end here, limited liability, what does that mean? Okay, by law, a owner of a limited liability entity is not liable for the debts and obligations of that entity merely because they are an owner. They can become liable, however, for other reasons, but just ownership is not sufficient. Those other reasons include, like we just talked about, you've basically not treated this separate taxpayer like it's separate. You've commingled funds. You've basically said this entity and myself are one and the same for all intents and purposes. You know, you've operated this as a sham or a criminal enterprise in some regard. You can also sign documents that obligate you for the debts of the company. The primary one being, if you go to the bank and you ask to borrow money, and they agree, the company will take out the loan, but you as an individual will guarantee the repayment of that loan. So that document that you sign, called a guarantee, will obligate you personally to pay back that particular debt. That does not mean that you then become liable for everything else. Let's just say something happens, the company has a personal injury judgment against it. That does not, the guarantee of the debt to the bank does not then mean you're going to become liable personally for that personal injury judgment against the company. The word limited in this limited liability concept means that you will have to risk losing your investment. It's not full, we're not discarding liability in its entirety. You might have some liability, limited liability, and that is you're just going to lose the investment potentially, or part of it that you made initially in the company. How do we choose? What are the selection considerations? Well, obviously tax. I've hit on tax a bunch. Liability protection. Image. Some of these more sophisticated LLCs or corporations, when you've got all of your books and everything prepared in a sophisticated manner, it does help with the image of the company. Ease of creation. You may want something that's very easy to create. You may be looking for credit. You may be looking to attract investors. And, how to decide what's right for you. There's really not much of a right or wrong answer. I hedged a little bit on saying that because there are some pretty good clues. It depends on what your needs are. And if you are in a high-risk business, I, without exception, will recommend some sort of legal or limited liability entity as your selection, whether it's a C Corp, S Corp, or limited liability company. There are some other limited liability type entities, but they're really beyond the scope of what we're going to talk about today. If you're not in a high-risk business, then you can prioritize using those other factors, whether it's tax, ease of setup, attracting investors, that sort of thing. Now, in just about any business you engage in, you're going to need insurance. Now, needing insurance and having it required by law are two different things. There are a few professions that require insurance by law. Just because the law says you don't have to have insurance, that does not mean you should not have insurance. You should always have insurance. Talk with your insurance agent. If you're engaged in any commercial enterprise, talk to a commercial insurance agent about what exactly it is you're doing, what sort of coverage it is that you're going to be needing. That's for any enterprise. That's for any entity, even a sole proprietorship. Now, for your limited liability entities, you're protected personally. Your company is still going to need insurance. For your companies where you are personally exposed, you may want to consider actually getting a little bit of bump up in insurance just to make sure you're really protected from any sort of judgment against you personally. Okay, now naming considerations for your business. Now I'm going to touch on this briefly because it can be important. You want to search for your entity's proposed names, okay? You can use Google. You can use the United States Patent and Trademark Office. The reason you want to do that is because there are mean, nasty lawyers out there like Kevin Christopher. Okay, he will come after you, and if you're using a brand name that's similar to one of his clients' brand names, he'll send you a nasty cease and desist letter, and you don't want to debrand. The best names to choose from your entities or for your entities are fanciful, arbitrary names. Names like Kodak. Okay, Kodak, if you didn't know otherwise, would not conjure up an image in your mind of a film or photography company. It's in reality, it's totally disconnected from film, but through strong branding, through marketing, advertising, that sort of thing, Kodak now is associated in consumers' minds with film and photography. Those are the strongest brands, believe it or not, because number one, they don't use generic names, light bulb or things like that for an actual light bulb. Obviously, if you use light bulb for a table manufacturing company, that would be a fanciful or arbitrary name. But those are the best ones to select, names that really don't have any connection with what you do. Now, if you are strictly a local business, and I've given some examples on the PowerPoint here, you know, Bob Smith Accounting or Jim's Lawn Care, if that's all you're doing, then those are more generic names. You really don't have a worry with somebody coming along and saying you're using my name. Okay. Other than that, you may want to give it some thought. And that's the end of my presentation. And as always, I'm happy to take any questions, and hopefully I'll be able to answer them. Thank you.